Anne Stevenson Yang, co-founder of J Capital Research and author, stated that because China's economy is on the verge of collapsing, the rest of the world should brace itself for deflation. As global inflation increases and Xi Jinping's Communist Party continues to campaign for a zero-COVID policy, China's exports have plummeted, lowering commodity prices. China's export sector is in risk after 2 years of extraordinarily strong economic growth in 2020 and 2021. Ms. Stevenson Yang stated in a statement to ABC News, "So my base case for China, I think, is that the Chinese economy is really going through a crash. I think that China is going to spew deflation into the world pretty soon, like about the third quarter of this year." So, if you want to understand what's going on in the second largest economy, watch this video and make sure to subscribe to our channel so you receive more of our interesting videos. Once again, experts in the West predict that China's economy will tank. Analysts believe that a debt bomb is about to explode while China is flailing. The government's zero-COVID policy, which keeps regions of the country under continual lockdown, will cause the property bubble to burst, create too much debt, and worsen the economy. Furthermore, the US imposed and purportedly backed by its Asian allies increased restrictions on China's exports and investments abroad. The year 2021 was difficult for China's real estate developers as a result of tighter financial regulations, which caused some of them, most notably Evergrande, to default on certain loan obligations. Evergrande, China's second largest private property developer, was on the edge of bankruptcy last year. The firm obtains funds by pre-selling an increasing number of flats, as well as from hundreds of thousands of individual investors, and then utilizes the funds to support future sales by accelerating existing development and paying down payments. When the market falls, however, cash inflows begin to lag behind the growing curve of cash needs. At Evergrande, there are now 800 unfinished projects and 1.2 million people on the waiting list. Mortgage payment boycotts by Chinese homeowners have affected at least 301 projects and 91 regions, threatening an estimated 2 trillion yuan, or $297 billion in mortgages. Over 70% of Chinese family wealth is in real estate. As a result, some Chinese banks have stolen customers' savings accounts under the guise of mortgage investment items. Without significantly affecting consumer price inflation, producer price inflation raised costs in 2021. High commodity prices, crowded traffic, a labour shortage, and high energy expenses all contributed to this. When COVID lockdowns impacted company operations, the world's second largest economy was already battling with rising energy and raw material prices. Because of the impact COVID limitations have had on consumer demand, businesses have found it more difficult to pass on the increased costs to customers. As a result, employment has fallen even further. There has been a minor increase in consumer price inflation as a consequence of producers starting to pass along greater costs to consumers. The consumer price index has increased as a result of somewhat rising food prices. Following Xi's crackdown in Hong Kong, one targeting big tech was undertaken on the mainland, commencing in late 2020 with Jack Ma, the founder of the Alibaba Group. As a result, Shanghai stocks plummeted. The problem is exacerbated by decreased retail sales in China and additional supply chain delays caused by zero COVID, which further clouds the outlook for corporate profitability. Xi Jinping has continued to emphasize the need of shared prosperity, which means promoting higher quality and more equal economic growth. Furthermore, in 2021, China passed a series of regulations, some of which targeted monopolistic enterprises and their anti-consumer practices. The initiative has already convinced wealthy individuals and organizations to make charitable contributions in an effort to reduce economic inequality prior to any government regulations. The quest for shared prosperity will grow until 2022, albeit it is uncertain how it will emerge in specific measures. More regulations and policies aimed at reducing inequality, as well as exaggerated and unfair economic rewards, may be put in place. Economic stability is the Chinese government's primary aim for 2022. Han Wenshu, Deputy Director of the Office of the Central Committee of Finance and Economics, stated during the Central Economic Work Conference that authorities should take care when enacting policies that constrain the economy. The World Bank has pegged China's anticipated growth rate through 2022 at 5.1%, which is much lower than the country's historical average. To boost its GDP, China would most likely raise its fixed asset investment. A significant chunk of money will be spent on infrastructure. The country will most likely continue to issue special bonds to partially pay fiscal spending. But wait a minute, what are the underlying causes of the current real estate crisis and debt growth? It may be directly credited to China's expanding private sector, which has received tremendous backing from the Chinese government, particularly in the banking and real estate industries. Why, of all countries, was home development in China left to private capital developers who gave mortgages to buy? Why weren't dwellings built for rent by the government sector? As a result, the state is now responsible for cleaning up a classic example of a Western real estate market crash. It is the responsibility of the state's local government to deal with this. However, the current real estate tragedy serves as a warning that the turbulence and irrationality of the profit-driven sector is having a growing influence on the Chinese economy. Both during and after COVID, the private sector has struggled. Here's one example. In Shanghai, COVID lockdowns were sold to the private sector with poor results, but in Beijing, they were managed directly by the local government with significantly better results. Thousands of people in central Henan province have protested against banks that have not returned their savings. Tens of thousands of homebuyers around the country have missed mortgage payments on delayed housing projects, and people across the country have fled COVID lockdowns. The social upheaval is the largest collective mobilization of angry Chinese citizens in years. Individually, they all stem from one of Xi's signature policies, hurting the president's reputation as he pursues re-election for a fifth term. People in China are clearly unhappy with the state of the economy, writes Stephen Sang, director of the SOAS China Institute at the University of London, and many see the problems as driven by the government's misguided policies. China requires overturning the growth of the private sector and starting introducing more efficient strategies for state investment, but this time with the democratic participation of the Chinese people in the process, and not by tanks out beyond banks. Far from being the solution to China's mini-crisis, demanding more liberalizing economic reforms towards capitalism, instead, the leadership's goal for shared prosperity will be just rhetoric. Did you find this video interesting? If so, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments.